7-year loan terms are here. Do you really want to be paying off your car in 2032? This is the title of an article that I stumbled upon today, and I wanted to kind of get into it a little bit. Now, of course, the answer to this question is no. And for any of you considering this, please don't. I mean, the auto industry has truly become an overpriced, nasty situation where the automakers and dealers just care about the short term, no matter what the cost is in the long term. This is why these 7-year loan terms are becoming more of a thing. I don't know how they convinced the banks to approve these ridiculous loans, especially on cars that are not worth anywhere near the loan amount, but somehow the automakers got the banks to hold their noses and go along with all this BS. Anyways, to start off, the article states, more new car shoppers are taking on 7-year loans, a trend that underscores the rising cost of financing a vehicle. 7-year loan terms made up 19.8% of all new vehicle financing by dealers in the first quarter of 2025, according to Edmunds. This is insane. 20% of auto loans are 7-year loans? You've got to be kidding me. Keep in mind that 20% of auto loans are also $1,000 monthly payments or more. The auto industry is essentially bleeding their customers dry. I mean, a 7-year loan term is not going to end well for anyone. By year 5, when the warranty ends, most people will realize that they're in no position to make any repairs, and so they'll just purchase a new vehicle and roll over massive amounts of negative equity. This is just a recipe for financial slavery. If you're getting into a 7-year loan term, you're signing up for a financial servitude. That's just the reality of the situation. Anyways, the article then states, car loans have grown steadily longer in recent years, as buyers labor to keep pace with rising prices. Nowadays, a buyer seems to have as many financing options as a home buyer. The fact that people need all these options to finance a car, a damn car, is just ridiculous. A car shouldn't be this expensive. The auto industry has lost its mind with these ridiculous prices, and quite frankly, I have no sympathy for any of these automakers if they start going bankrupt. When you have no consideration for the consumers that buy your product and have no qualms about screwing them over financially in the short term, you deserve to go bankrupt eventually. And I think a lot of these automakers are going to learn that the hard way, because it seems like no matter how many signs you show them, and no matter how many reports come out about the state of your average consumer and about how much financial distress he's in, it seems like they just don't care and they're just going to continue on with these high prices. I think for a lot of these automakers, not all of them, for a lot of them, it's just going to end very poorly because their customers are just not going to come back because they can't afford to come back. Just look at what's happening right now with Stellantis, for instance. Anyways, the article then starts talking about how, purchasing a car, you're just in negative equity and it's not really a good financial investment. It states it's not money that you get back. It's not equity that you have in the car, said Brian Moody, executive editor of Kelley Blue Book. Speaking about equity, it's interesting. We live in a society where people are priced out of appreciating assets like houses because depreciating assets like cars have become more expensive. It's like the economy is set up in a way that consumers are just being pushed towards financial servitude rather than financial independence or freedom. The auto industry and what's going on is a prime example of that, because wherever you go, whether you go in the used car market or the new car market, it feels like you're just going into a situation where you're overpaying, you're being squeezed financially, and these businesses have very little regard with your ability long-term to build yourself financially with what they're charging for this, even if it means that you're not going to be coming back to them anytime soon. So then the article continues with, here's another worrisome trend. Many cars are losing value at a faster pace than the borrower repays the loan. You wind up owing more than the auto is worth, a predicament known as being underwater or upside down. The longer your loan, the greater the risk of slipping underwater. Well, thanks for mentioning that, Captain Obvious. The longer your loan, the higher the risk of slipping underwater. And that's why I say a lot of these people are not going to go through with the loan for the full 7 years, because by year 5, they won't have enough money to pay for both the repairs and the payment. And they're in a situation where even if they try to sell the vehicle, they'd still owe a bunch on it. So they're just going to have to go back to the auto dealer that they bought it from and try to get them to get into another vehicle and at the same time roll over a bunch of that negative equity. And what's essentially is going to happen is people are just going to perpetually be in a bunch of negative equity. And then the article then talks about the rule of thumb in car buying known as the 24-10 rule. And it says that you should make a 20% down payment, cap your loan at 4 years, and spend no more than 10% of your monthly income on transportation. So it's interesting because I actually entered the numbers into ChatGPT using the average salary of a single American who works full-time, as well as the average salary of the American household. And according to ChatGPT, using these numbers and the average price for gas and insurance, your average American, single American, can only afford a $12,000 car, and your average American household can only afford an $18,000 car. So take that into consideration. Your average American is not even in a position to buy your average used car, let alone your average new car. So it really goes to show you the direction that the auto industry has gone into, where we're basically buying cars at these average prices is financial suicide, even according to the experts, right? And the experts are probably overly optimistic about the ability for a lot of these people to afford it. But the fact that even they're saying, yeah, the average new car price and the average used car price, they're just a really bad financial decision for most Americans. And then the rest of the article starts talking about how we got to this place and how the loan terms have been essentially increasing over the past few decades. I think much of this happened over the past 5 years, ever since the pandemic. I think the pandemic really put the auto industry in another direction where the concern for the financial well-being, the long-term financial well-being of their average consumer was completely taken out of consideration. And I'm not saying that it was taken into consideration prior to that, but there was at least some sense of restriction, some sense of sort of restraint due to the fact that car prices were cheaper and people were used to cheaper car prices, that prevented a lot of these automakers from really screwing over their consumers with high prices. The pandemic really paved the way and opened a Pandora's box where they were like, we can stretch the consumer far more than we had thought. And unfortunately, it's just been downhill since. Let me know what you guys think about this whole situation. Links to the articles are in the description below. And as always, if you enjoyed this, make sure to click like and subscribe. See you guys in the next one.